Well, Nerina, the market started flat today, and from there it's just headed south. It appears that some caution is returning to these markets following those new measures in China to rein in its economy.
Absolutely. I think what we're seeing is major nervousness around commodity prices, and definitely on the back of two factors. Both of them have been mentioned already. The one is the Chinese economic numbers, both on the GDP as well as on the industrial production side. Both of those being very strong and indicating that the Chinese central bank would have to have a strong look again at its monetary policy and implement some further tightening measures there. The other factor, of course, is also the dollar strength. Bear in mind that the majority of commodity prices are denominated still in dollar terms, and that obviously, so the dollar strength obviously also weighs on the commodity prices. This is translated for the second day in a row into weakness in our commodity sector, with the big market caps, Anglo's Billiton and the platinum and gold stocks leading the way further down. An interesting point for us is that when we look at the inventory levels of commodities at this stage, we are most concerned about copper and nickel in particular, because those have got quite comfortable inventory levels at this stage, and with a decline in the commodity prices, you will definitely find a rundown of those inventories rather than rebuilding. So those are the two commodities that we're most concerned about, and obviously our major diversified miners, players in those markets, and hence the weakness that we see in our big diversified mining companies.
Of course, those commodity prices, as you say, have really run up with that Chinese economy. And we have copper prices, for instance, more than doubling from $3,000 a tonne to about $7,500 a tonne. Do you think there's going to be a big retracement in these metal prices? And if so, how's that going to translate into share prices like Anglo American and Billiton's?
I think we have the combined double whammy at the moment of signs of tightening in China as well as the strong dollar, and neither of those are good for commodity prices. If you add that to the picture, as you've mentioned, that commodity prices have certainly run very hard in dollar terms, I think there is quite a bit of downside potential from current levels. I think that certainly will translate into further weakness for our major commodity stocks. Probably the balancing factor here could be the impact on the rand itself. We've seen the rand actually react relatively mildly to this particular strength that we've seen in the US dollar over the last couple of days, and contrary maybe to what one could have expected, the rand dollar could have weakened a lot more than it has, but we've still seen very strong inflows from foreigners into our equity markets, net inflows of almost 2.8 billion in the first 2.5 trading weeks that we've seen so far. So still a lot of support from foreigners for our equity market, and hence the inflow has supported the rand, so that it's really dollar strength that translates into the rand dollar apparent weakness. But we find that against the crosses, the rand is actually still looking very, very comfortable.
Now, Nerina, we saw at the beginning of the month when China announced that it was going to be raising the reserve requirements for its banks, we saw a knee-jerk reaction from the markets. It only lasted a day or two. Do you think it's going to be the same situation now, or do you think this is serious stuff?
I think it depends very much on what the Chinese response to these economic figures are. When we look at the reserve requirements, at first glance, I think most people did have a bit of a negative reaction to it. But when you look deeper into the numbers and acknowledge that they raised the reserve requirement only from 16 to 16.5%, and that this was already more than double the requirement that Basel has for the reserve banks, I think the reaction was that maybe this is not as serious as it appears. However, how the Chinese bank reacts to the latest numbers that we've seen, I think will be indicative of whether this is just another blip on the commodity horizon, or whether this is maybe the start of something a little bit more ominous.
Well, like you say, maybe something more ominous, because inevitably the stimulus that's been pumped into economies around the globe has to be withdrawn at some stage. Perhaps starting with China, are we now starting to see markets having to stand on their own 2 feet?
Maybe to some extent, the stimulus is still there. The cheap money is still very much around. So in terms of asset prices, not much has really changed around the globe. We are now seeing the tightening feeding into the economics, into the fundamentals of these companies. But as long as the cheap money is still around, you'll find that there's a lot of support for asset prices in particular. And when we just look sort of at the overall world markets over the last couple of days, there are so many factors at play here. consumer. You'd think that Japan would have been negatively affected by the likes. Actually not, because what happened there was that the strength in the US dollar, of course, caused weakness in the Japanese yen, which is very good for their exporters. So this morning we see the Nikkei up quite strongly. Contrary to that, of course, the strong dollar is not good for American companies. And when you combine that also with some weaker than expected results out from the likes of Morgan Stanley and IBM, the US market, equity market, did not look very well. In Europe, you've got the impact of Greece on its borders and what the ECB will do around that issue. So a lot of nervousness in Europe. But the point is still that there's a lot of money, cheap money floating around looking for a home. And as long as we have this high yielding environment within South Africa, almost regardless of what the commodity picture looks like, I think we'll continue to attract the inflows into our equity markets.
Of course, along with those Chinese growth figures out, and we also had Chinese retail sales figures, and looking pretty strong over on that side. And our own retail sales figures contracted by 6.6% in November, much worse than the 5% that was expected by the markets. Yeah, we've had some pretty positive, or not positive, but not negative trading updates coming out of companies like Woolworths. We had another one out of Lewis today that didn't really look too bad on the face of it.
Yes, I think we must bear in mind that the retail sales figure that was announced yesterday was for November last year. Certainly much worse than the market expected, and clearly showing that the South African consumer is still on the deck. But when we look at the trading updates of many of our retail companies, many of them indicated much better growth and sales revenue during the last 4 to 6 weeks of the trading period leading up to the end of December. One could argue that on a seasonally adjusted basis, this won't really mean much for retail sales figures, but I think the December number might look a little bit better than November number, especially from a base effect point of view. If we just look at some of those trading statements that we've seen, most of our listed retail companies have now announced their trading statements. We've certainly discussed some of the other ones over the past couple of days. Woolies being the latest one, a very good trading statement out of Woolworths. They obviously have the diversified offering of food as well as apparel, and then also some of the homewares, and certainly all divisions showing some very good improvement. On the food side, we find that Woolies has been able to maintain their positioning there and maintain their market share. And on the apparel side, we saw yesterday that the market share losses that Mr. Price showed us last week probably went to Woolworths, because they certainly had some market share gains there. Another interesting feature from Woolworths results was the fact that their margins they were able to widen their margins, mostly on the back of the strong rand, which allowed them to benefit from cheaper imported prices, and the wider margins certainly translates directly to the bottom line.
Nerina,
Final comment maybe. Sorry,
Nerina, I'm afraid we're out of time, but thank you very much for your input today. That was great.